Hello, my name is Lisa Meyer and I am with TrustPoint. Today I'm here with Allyson Krause and Brett Sebion, and we are going to cover the 401k plan highlights. Brett will cover the market overview, and then Allyson will provide a financial action plan. First, we can start with our full menu of services. So I know you're all familiar with our retirement plans that we offer for businesses, but we also provide trust and estate administration. We work with individuals and businesses to provide investment and wealth management, and we work with foundations and nonprofits. So if you or you know of somebody who's interested in any of these other services, we would be happy to lead you in the right direction and to connect you with the expert in that area. We'll start now with the 401k plan highlights. So with River States, you're eligible to participate at age 21 once you've completed 60 days of service, and you are eligible for the match after 1 year. The match is discretionary, but it's currently 100% up to 4% of pay. So just know if you're contributing 4%, you are getting all of the match money, which is really a huge benefit. The match is subject to a 6-year vesting schedule. For distributions, you are able to take distributions at age 59 and a half, at retirement, if you terminate your employment, or death or disability. And TrustPoint is the plan trustee, and River States is your plan administrator. So here you can see the 2020 contribution limits. Currently, it's $19,500 if you're age 50 or under age 50, and at age 50 and above, you can contribute up to $26,000. Again, as I mentioned before, the match is 100% up to 4%, so this is a great benefit, and we really, recommend taking advantage of it. And it's basically free money for you for your retirement. So it's really important to be participating in the plan. So here, we're covering really how much you need to save. So most people will need to replace about 70 to 85% of their income for each year in retirement. What that means is really saving 8 to 10 times your ending salary. So if you think of whatever your salary is at the time that you retire, just know that you'll need really 8 to 10 times that amount for retirement, or most people do. And advisors generally recommend people are saving between 10 and 15% for retirement. And if you feel like that's really hard to do, or you can't do that now, a good way to help yourself get there is really to increase your contribution 1 or 2% a year. And doing that can really help you without it feeling like a big impact to your paycheck. Your plan offers both Roth and pre-tax options. So pre-tax is really the traditional way to save for retirement. Your contributions go in before tax, and when you pull it out in retirement, you pay the taxes at that time. With the Roth, contributions are made after tax, so you're paying taxes today. It grows, and when you pull it out in retirement, the earnings are tax-free. So you're not paying any taxes at retirement with your Roth account. You've already paid it on the contributions, and you wouldn't be paying it on the earnings. So it just depends if you want to pay taxes now or later. And of course, you can choose to contribute to both Roth and pre-tax. In your plan, just know the limit's $19,500 in total between the two, or you can choose one or the other, or change at any time. So just know that those are both options within your plan. And on the next page, we cover really who benefits the most from a Roth account. So if you're young and far from retirement, obviously you have many years to let the earnings grow and compound. So that can be a really big benefit. Also, people who want to leave tax-free money to beneficiaries, so by paying the taxes now, if they have that income left over, their beneficiaries will not have to worry about paying taxes at that time. And then those that really want to have more distribution options. So that could be for a large purchase in retirement. Say you have to purchase a car. And you don't normally need that much income in a year, but you do because of that purchase, just know with a Roth, that way you're taking that money out and you're not having to worry about paying more taxes that year because you've already paid taxes on the Roth. Another thing to consider is a Roth IRA. People look at this as another option because income limits apply to Roth IRAs where they don't within the 401k. So anybody is eligible in the 401k to contribute to the Roth regardless of their income. It's really important to keep your beneficiaries up to date. On your statement, you'll see on the last page, we list out who your beneficiaries are. So please remember to take a look at that and make sure that you keep that information up to date and make changes as needed. On the following page, we will cover really consolidating accounts. So here we're talking about if you have 401k plans or IRAs outside of the River States plan that you want to roll over. There can be benefits of consolidating your accounts. If you're in an IRA, you could potentially be paying more in fees, not always, but you could possibly be. And we're happy to review any statements you have and help you if you're interested in making that change and rolling it over into your plan. Please call TrustPoint and we'll be able to help you through that process. And now Brett will cover the market overview.
Thanks, Lisa. So just to kind of lay the foundation of what I'll be talking about, kind of give a high level overview of markets in general, talk about kind of where we came from, where we are today, and where we might be going and some of the factors driving that. And then we'll get into a couple political slides because 'tis the season. We'll also get into some coronavirus pandemic slides, and then just a couple slides of what TrustPoint generally thinks about the market and asset allocation and portfolio construction. So feel free to take notes during the slides as we're flipping through these and reaching out to me or the investment team or anybody at TrustPoint if you have additional questions on the material. So the first chart we're looking at here is a 5-year chart of the global fixed income market. So it's a representation of world bonds, investment grade, high quality bonds. Don't want to go through each talking point here, but basically there's two big stories to take away from this slide. So the first part is this 2.5 year period from 2016 through Q3 of 2018, where global bond prices around the world were essentially flat. There was a cap on bond prices. And that was really due to the Federal Reserve's monetary policy. They were either raising interest rates or the markets were expecting interest rate increases. And we know there's this inverse relationship between rates and bond prices, right? So as rates rise, bond prices tend to fall or stay flat. And that's exactly the environment we were experiencing over this time period. Now, Q4 of 2018 and basically through where we stand today, we've seen global bond prices around the world rally significantly. And again, it was mainly due to the Federal Reserve's monetary policy. They kind of switched their tone and how they went about monetary policy. They were raising rates over here, and over in this period, they were either cutting rates or markets were expecting interest rate cuts. So as rates fell, bond prices around the world rallied. And we can definitely see that numerically on the second page here, within asset class returns within the fixed income market. We don't need to go through each one, but global bonds and US bonds, the aggregate bond, which is essentially the proxy for domestic and international bonds, very strong returns year to date. Another one that I'd like to point out is this intermediate term treasury. So it's kind of that 7 to 10 year period of a government bond. The year-to-date return almost 10%, which is not something that you tend to see over shorter time periods within the fixed income market. This is not something we would forecast to happen going forward. We would tend to see, even lower than some of these longer-term returns in the previous 5 years going forward. But you tend to see them kind of in this, low to mid single digit, not in the upper single digits. So. But needless to say, it's been a strong rally within the fixed income market across asset classes year to date. The next chart here is a 5-year chart of global equity markets. So it's a representation of world stocks. Backing up a little bit, you can see stocks essentially went straight up with no interruption in 2017. What followed was different periods of volatility, whether it was the Federal Reserve increasing interest rates, which tend to act as a headwind for stocks, or whether it was the uncertainty that was surrounding the US and China trade war, or most recently, the coronavirus pandemic that sent global stocks down about 33%, peak to trough. Sorry about that. Technically speaking, it was actually the quickest entrance into bear market territory that investors have ever experienced. But then on the flip side, it was actually the quickest exit out of bear market territory that investors have ever experienced. So that's where you get kind of this V-shaped recovery. And we'll get in to a little reason why that might have happened. We have the stock market over here, the economy over here, and people tend to think there's some type of disconnect, right? Which makes sense and is a fair point. We have stocks kind of rallying to all-time highs, but then we have the economy where there's still millions of people unemployed. There's industries that have been impacted forever and might never get to go back to how they were operating daily, right? But we'll get into that. But the next slide here kind of numerically shows the returns year to date and over different time periods. We can focus on year to date. Global equities through August were up about 5.4%. That's pretty spectacular given that we had that 33% peak to trough decline in March. But with that being said, the market rebound has been very kind of narrowly impacted, right? So what I mean by that is if we look at all these asset classes, which one sticks out the most? Well, it's the US large cap growth, right? So what kind of stocks are in that asset class? Well, it's Apple, Amazon, Netflix, Google, Tesla, all these big cap technology stocks that have really done the heavy lifting for the market. Another thing I'd like to point out is the variation between US large cap growth, those stocks we just talked about, and US large cap value. You can see the variation, between the two is about 40%, which is really unprecedented, something that investors don't typically experience over different time periods. But it just goes to show you that heavy lifting that those large cap technology stocks have had on the market year to date. And, really, if you want to take away kind of a big macro idea from this slide is that, large cap has done better than small cap and growth has done better than value. And we'll get into that a little later. But that's kind of the big story with year-to-date returns within asset class returns in the equity markets. The next couple slides will kind of set the stage on why markets might have rebounded so strongly while the economy and the job market has not. So the first slide here is S&P weightings by industries and top holdings. So in red are the industries that have been negatively impacted by COVID, and they make up about 6% of the market, or the S&P 500, which is the 500 largest companies. In green are the industries that have benefited from COVID. And, it's the software companies, the technology companies, semiconductors, and they make up about 41.5% of the market. So why markets have rebounded so strongly, or one of the reasons they have rebounded so strongly, is that the industries that have benefited from the coronavirus pandemic actually make up a large part of the market, while the industries that have been negatively impacted by COVID make up a very small portion of the market. So the airlines, the leisure products, department stores, entertainment, things where those industries have been changed forever, but their footprint in the market is just not as great as those industries that have benefited from COVID. So that's one reason. The next couple slides have to do with monetary and fiscal policy. So monetary policy is basically what the Federal Reserve and central banks around the world can do to help support economies and asset prices. We don't need to go through each program here, but basically these are stimulus programs that the Federal Reserve can tap into to help support economies. This is the stated capacity that they can do, what they've done in dollar terms, and then the utilization rate, what they've done in percentage terms. So while their footprint has been large in supporting economies around the world, the utilization rate of those programs is actually very small. So they can still do more. They still have a lot of ammunition left to say, a lot of, to leverage tools in their toolbox. But the impact they've had on markets is great, and they can continue to do more if they decide to tap into a larger degree. On the other side, we have fiscal stimulus. So that's what federal governments can do. So there's countries down here, and basically it's numerically putting, forth their fiscal stimulus as a percent of GDP. So the turquoise bars here are what nations did in response to the great financial crisis after 08, so 08 to 2010. And the dark bars are what economies have done, federal governments have done rather, in response to the coronavirus pandemic in the current year here. So you can see back in 2008, some of us were around, the response from federal governments was very large at that time. Well, the response has been even, 3 to 4 to 5 times larger in response to the coronavirus pandemic. So you throw in the industries that have been impacted from COVID don't generally make up that large of the market. And then the stimulus measures taken by central banks around the world on the monetary side and by federal governments around the world on the fiscal side, you get this kind of, group of support that has helped markets kind of rebound so sharply from their March low. The next couple slides have to do with the election. So RBC Capital Markets did a survey, the percentage of institutional investors who are worried about the following issues, and you can see those issues here. No surprise, the top of the list is the 2020 election, right? There's always some type of volatility and worry around the election about who will get in, how they'll impact industries, how they'll impact markets. And so it's no surprise that this year institutional investors and investors in general are worried about the election. The next slide, as it's titled, Markets Don't Care Who's President, right? So this is a chart that goes back to 1860, and it's based on a 60-40 portfolio, so 60% stocks, 40% bonds. And you can see under a Democratic president and a Republican president, the returns of markets are essentially the same, right? So markets tend to be long-term in nature. They tend to focus on the optimism surrounding the world, not the pessimism, over longer periods of time. And the fact of the matter is they don't necessarily care who is in office, right? Anything can happen short term. There can be any amounts of volatility that can happen short term, but over longer periods of time, and as this slide shows, markets just generally don't care who's in the White House, right? And the next slide, and sorry for kind of the upfront title again, but markets also don't care if you don't like who's president, right? So what's shaded in kind of a thick red box here is the presidential approval rating. 30 to 50% is actually, historically speaking, a sweet spot, so to say, for market performance, right? If the presidential approval rating is too high or too low is when you see low market returns. But when, there's a little bit of back and forth between parties and between, Americans who support those parties is actually when the markets perform the best, historically speaking. So what fun would life be though if, markets didn't price in some type of predictions, right? So historically speaking, investors around the world have found out if markets are generally rising into the election, it tends to mean the incumbent party wins. And when they decline into the election is when the incumbent party loses. So there's going to be, a new side in the White House. Markets were going up and then they kind of had a little correction. Now they're just kind of consolidating. So, not a lot of evidence one way or the other, but just something to keep in mind, not only for this election, but, elections going out. To see, how right the market can be when it comes to pricing in who is going to be in the White House. The next couple slides have to do with the coronavirus. So we know daily cases have been expanding, right? Whether it's the reopening of economies or we're testing more individuals, cases are rising, right? And that's going to happen. But on the flip side, daily deaths really haven't increased. We get little spikes here and there, but the general trend is not getting any worse, which is very encouraging, right? And that's because of all the therapeutics that, we're working on, or the scientists are working on. Hospitals are better equipped to handle these patients that are coming in with severe symptoms. But, regardless, it's a very encouraging development, right? And then the next slide here has to go over kind of and we don't need to go through each talking point, but basically what I want to point out is the unprecedented speed of which science is working to help us all get back to normal, right? So today there is 180 vaccines and 500 therapeutics in development. The first vaccine for high-risk populations, this slide may be a little old, but as early as October 2020, that's being very optimistic. But it wouldn't surprise me if, for the highest risk populations that have, are at the highest risk of dying from this virus, there wouldn't be some type of vaccine potentially available for the end of the year. And then 4 to 5 vaccines entering the pivotal phase 3 studies which means the phase 3 studies essentially mean that they can do these different types of studies on larger groups of people. So instead of 40 or 50, they can do it on tens of thousands of people, right? So encouraging developments when it comes to battling this coronavirus pandemic. So the next couple slides will touch on what TrustPoint generally thinks of investments and portfolio construction and asset allocation within portfolios. We don't need to go through each talking point here, but just to point out some of the bold points here under asset allocation, tactically the risk reward outlook for stocks versus bonds appears to be roughly in balance. Our bias is starting to favor equities relative to fixed income, and we'll get into that in the next slide. But as always, it's important to maintain a diversified approach, right? So having that mixture of stocks and bonds and not letting emotions or political views dictate investment decisions, right? Because we're long-term investors here. We want to have a long-term mindset. On the fixed income side of things, government bond yields have collapsed, right? So bond prices fell, or bond yields fell, bond prices rose. That's not something that we're forecasting in the future. It's going to be a lot harder to have price appreciation and to have positive returns in the bond market. And then on the equity side, volatility will remain elevated, for certain periods of time, but equities have generally been driven by news related to COVID, and probably more importantly, policy responses and their macroeconomic impacts. So that's kind of what the Federal Reserve has done, what federal governments have done. Markets are paying attention to that stuff, and it's having a substantial impact and probably will continue to going forward. The next slide here is a tactical asset allocation slide going over the two broad asset classes, fixed income and equities. So this is based on a balanced growth portfolio, right? So if we had no biases in the market, TrustPoint had no biases, in a balanced growth portfolio, we would be 50% stocks and 50% bonds. What this is telling you is that our bias is slightly underweight fixed income and slightly overweight equities, meaning we are slightly favoring equities over fixed income in a balanced growth portfolio. Now, it doesn't mean we're selling all of our fixed income investments. It just means we're slightly favoring them. So maybe like a 52.5, 47.5 allocation. And that's really a couple of the key points here. Stocks are supported by very easy monetary and fiscal policy, and we've gone over that, right? But the Federal Reserve and federal government have basically committed to continuing to support economies and asset prices. The second point here, economic growth and earnings are weak, right? They're going to be negative in 2020, but they are improving. We got to remember, prior to the coronavirus pandemic, the economy was very healthy. We had a very strong job market. There were no imbalances in the market like there were in 2008 when the banks were misbehaving and people were leveraging up, whether it was their houses or different forms of debt. There really wasn't a lot of those excesses in the market, right? So when we finally have a vaccine and we finally get back to normal, we should see an acceleration in growth within the economy. And then on the fixed income side, we've talked about it a couple times now, yields have collapsed basically to near zero. And looking out into the future, it's going to be very hard for yields to continue to go down and bond prices to move up. Now, we're not forecasting a substantial increase in interest rates where that would collapse the bond market, but going forward, from a risk return basis, when we talk about a balanced portfolio, we're slightly favoring equities looking out into the future. And the last slide I will touch on kind of has to do with tactical decisions within the equity bucket of our portfolios. So we're slightly favoring international equities over US equities. And this is just one of the supporting slides. So basically, this chart goes back to 1974. The green area is when US stocks have outperformed international stocks. And then the red is when they've underperformed. So you can see when one or the other is outperforming each other, it tends to happen for longer periods of time. And this is the most recent time, and US stocks have outperformed international stocks for quite some time. Now, that's not to say that the trend will reverse tomorrow or next week or even next month, but when we're looking out, 2 to 3, 5 to 10 years, we believe that international markets, it might be their turn to outperform their peers on the domestic side. That is all I have for you guys. I think I'm going to give it back to Allyson here to talk about some financial action plans.
Thanks a lot, Brett,
Yeah.
for that review of the market. And thanks, Lisa, for going into a little bit more detail on the 401k plan. So some of you, if you want to go to the next slide, Brett, some of you are probably wondering now, what am I supposed to do with all of this information? Because it's a lot, right? And, you know, a lot of you aren't experts, just like I wouldn't want to have to try and figure out how to fix a diesel vehicle. A lot of you don't really want to manage your 401k investments. So I'm going to give you an action plan today so that you can take the information that you heard from Brett and Lisa and really use it to your advantage as you save for retirement and feel a little bit more confident in the process. So you've all heard of the food pyramid, right? This is the retirement period. So this is how I want you to kind of think about your plans for the future. On the bottom here, we have know your benefits. So that was Lisa's section, right? She talked about what you have available in the 401k plan. There are other benefits that I will very briefly cover that you may or may not be aware of that exist in your company. Manage your investments. Lucky you, you get to manage your own investments. That's probably really scary for some of you, but we're going to make it easier on you. So kind of what Brett covered, that can help you to make decisions that are going to benefit your overall savings over time. And before I say anything else, I want you to know that we don't expect you to be an expert. So what we want you to know is who the experts are. That's why we're all here today. So never hesitate to reach out to us if you have questions, concerns. You know, one thing that I do a lot, I know Lisa does too, you know, if you're feeling fearful, if we're heading into this election and you were just panicked and you're about ready to click that button to change your investments, give us a call. We can talk you through it. We can help you feel more confident with where you're at. Maximize your savings. You know, there are a lot of things that are outside of your control, like your investment returns, but you do have some control over how much you put into the plan. So how can you find ways to kind of maximize what you're actually contributing to increase your overall savings? And then plan, what does that mean? How do you set your retirement goals? How do you know if you will be able to retire at the age that you'd like to? So that's kind of our retirement period. So knowing your benefits, it's really difficult to know how to plan, how to kind of get to the top of the pyramid without having that foundation of what's available to you. So if something were to happen to your job, what would you do with your health insurance? What options would you have if you retire before you're eligible for Medicare? What are your healthcare options? You know, that's something that you want to kind of start thinking about, especially as you get closer to retirement. What life insurance options do you have that are provided by your company? What kind of disability benefits? You know, a lot of us sign those forms every year and don't really understand them, me included, or look into what would happen if something happened to us. It's great to ask those questions to be a little bit more informed as to what benefits you have. Your retirement plan options, that's why we're here today. You know, hopefully you feel a little bit more confident in terms of what's available to you, especially in terms of, you know, putting in 4% to get the 4% match, having Roth and traditional options. So, you know, our goal is to kind of help you just understand it at a high level, knowing that that is a huge benefit that the company is providing. Do you have outside accounts? You know, have you been employed in the past by a company that had a pension plan? Most of you, that's probably not true. Unfortunately, there aren't many of those anymore. But some of you may have purchased an annuity. So you're going to have something that looks a little bit like a paycheck in retirement. You know, in essence, your Social Security benefit is a form of a pension. Are you 34 like me and wondering what Social Security might look like when you get to retirement age? Or are you really close to retirement? You already know what your full retirement age is. What age should you take your retirement? So there's a lot of questions that you probably have. Again, you don't need to be an expert. You just need to know that all of these benefits are there for you and who to go to find out more information at the right time. Managing your investments. Again, this is probably the most stressful part for most of you investing in the plan, especially as we come up against things like, well, a pandemic, which none of us have ever really experienced before. The election coming up at the end of a pandemic year. It can be very stressful and kind of gut-wrenching to watch your account balance take the roller coaster ride, especially for some of you younger folks who are more aggressively invested. So the main thing, one of the most important decisions that you make is your asset allocation. What do I mean by that? How much do you have in stocks? How much do you have in bonds? How much do you have in cash? So if you really want to simplify it, you know, you kind of want to figure out how much risk you are willing to take and how much risk you can stomach. And we can help you with some of those decisions. We have a risk tolerance questionnaire that we can provide. So we'll give you our contact information at the end so that you can reach out if you're feeling really uncomfortable, kind of with where you're at or have questions. Establish an emergency fund. You know, I think a lot of us wish that we would have known about the virus a little bit sooner so that we could have prepared and had some cash reserves. Again, it's impossible to prepare for something like this. None of us have ever lived through it before, but we can make choices that help us to prepare for future events that we're unprepared for, because there will be more. We always know life is filled with uncertainty. So 3 to 6 months of expenses in something that's easy to get at, you know, non-taxable, that's kind of a good rule of thumb. Start with $1,000. You know, a lot of people start there, regardless of how many months expenses that might cover, and then kind of work your way up as you pay off debts. Maintain stock exposure. So I have a lot of people who are close to retirement who want to move to cash, meaning they want to sell all their stocks and take as little risk as possible right before the election. And I get it. From a psychological perspective, that makes sense. If you look at the long-term history of the markets, you will be much better off keeping a 50 to 60% stock exposure, even in retirement, as hard as that is to believe, and as hard as that might be to stomach. If you can kind of convince yourself to just stick with it and stay the course even into retirement, you're going to outpace inflation, which again, we never know what that's going to do. You're going to have the potential to be able to take out a sustainable withdrawal rate, meaning a certain amount each year that will help you meet your retirement goals and your spending goals, and not risk running out of money before you pass away. And then again, stay invested. So the next 2 slides, I will just quickly cover. If you look at these returns by asset classes, it's a 20-year period from 1999 to the end of 2019. So if, for example, you were to buy into the S&P 500 in January of 99 and you held that fund until the end of 2019, you would have gotten a 6.1% rate of return. The average investor over the same time period got a 2.5% return. Your average investor was not calling up TrustPoint and letting us talk them off the ledge when markets got stressful. Your average investor was trying to look into the crystal ball and figure out the best time to buy and the best time to sell. And guess what? If any of us was any good at that, then the 3 of us probably wouldn't be here today. We'd be sitting at home on a big pile of cash. The moral of the story is, you know, market timing doesn't work over the long term. So instead of thinking about timing the market with a 401k plan, especially, it's about time in the market. So that's my catchphrase for you today. Again, market timing doesn't work. So if you were invested from 2000 to 2019, that's 5,035 trading days. Again, S&P 500, 6.1% rate of return. If you missed just the 10 best days, and unfortunately the best and worst days tend to happen right next to each other. So one day you might get out and then you miss a great day the next day. And we've all seen that happen, especially this year. So if you even just missed the 10 best days, you're down to a 2.4% of return. That's only 10 days missed. I don't know about you. I don't want to be responsible for picking out the 10 days that I can, you know, not be in the market and miss out on that much return. So my goal, you know, again, you don't have to be an expert. I'm basically telling you today that you can pick something that works for you and you can stay there for a long time. And that should make you feel pretty good. You don't have to be thinking about this constantly. We'll kind of talk about a couple of times when you might want to consider a little bit more if your risk tolerance has changed. So the next step of the pyramid is to maximize your savings. So again, this is what you can control. Consider whether it's a good idea for you to contribute to Roth versus pre-tax. Lisa mentioned some of those tax benefits. Talk to your tax preparer. Can you get a tax savings by switching to pre-tax or going the Roth route so that you have more tax-free savings in retirement? Maximize that match. Put in that 4%. For some of you, you may not be contributing now, you know, or the 10, 15% of your salary that Lisa mentioned just sounds absolutely crazy, like you're not going to have any money to live on. Make 4% your goal. Anything is going to help, and you have control over how much you put in. Establish taxable accounts. So Roth is one example of that, but this is more in reference to outside savings accounts. So once you've maximized the amount you're putting into IRAs and 401ks, then set aside money in an investment account or, you know, a savings account with a good rate of return that's going to allow you to purchase things in the future without having to worry about tax implications in retirement. And then the plan. So this is kind of where we come in, or where the experts come in. I'm not claiming to be an expert in everything, definitely just on the 401k side, in fact. But we do offer individual meetings. So you will be getting information on an individual meeting sign-up time that you would have available to you, where you can speak with me or Lisa, kind of talk through where you're at, any concerns that you might have. And then as you get closer to retirement, it becomes even more important to consider things like, what date am I officially going to retire? How much am I going to spend in retirement? You know, do you have your debts paid off? Are you going to have a mortgage payment in retirement? You know, most people think that health insurance or, you know, healthcare costs are the biggest kind of spending category in retirement, but it's actually housing is what ends up being the most expensive over the course. So what is that going to look like for you? What insurance do you have available to you? Do you want to travel? You know, you may have heard of the go-go phase, the slow-go phase, and the no-go phase of retirement, right? So you don't need to, you're probably not going to be traveling into your 90s. So all those things, you know, it can kind of sound overwhelming as you start to think about it. That's where kind of having someone come alongside you, working with you on some of those goals, that can be really helpful as you get closer to retirement. Most of you who are not close to retirement don't really need to, you can kind of self-direct until you get to a point, you know, 5 to 10 years out, where you may want to look at it a little more closely. Review that periodically. We offer these individual meetings each year. And then really important to have an estate plan in place. People's least favorite topic. No one wants to talk about death, but it's a huge gift that you can give. And I promise you, it's not as painful as it seems when you're just thinking about it. So a couple of things that we can help with. Ask your friends who they've worked with. I always just recommend kind of reaching out for referrals from other people till you get to the point where you're comfortable asking for help. So again, you know, we want you to understand your benefits. If you really feel like you don't have a handle on what your company offers, ask questions. Karen and Rick, that's who Lisa and I work with most frequently. They are fantastic. They are going to know the answers that you would at least need to make an informed decision. Start working on an emergency fund. If you can't save 1,000, save 500. Work your way up until you get to that, you know, 3 to 6 months expenses. Have a budget. Think about how much you're spending now and then how much you might spend in retirement. Try and dump as much as you can into savings. Look for ways to kind of cut money out of your spending. Diversify your portfolio. You know, don't put all your eggs in one basket. Ask us for help if you're kind of confused about what that means. Managing your investments, same thing. Understand the impact of inflation. You know, that $5 bag of flour, a $5 bag of flour in the future is going to be like half the size. That's what inflation is. Those are kind of the things that you need to think about when you're saving. And then lastly, if everything that we've said just kind of went in one ear and out the other, we know that you are brilliant, but that we all have enough of our own kind of expertise and information in our head. So no judgment. Don't ever hesitate to reach out to acquire more information from TrustPoint, your employer, from other financial advisors in the area. There's a lot of people who want to help you. This is our contact information. So we've spent some time talking with you today, obviously. So if you called, we would be unavailable. But the good news is we have a whole team behind us. They know your plan. You know, they understand how everything works, and they're always happy to help. So call our main line, 608-782-1148. Ask to speak with a member of the retirement plan services team. You can say, you know, where you work, and they will direct you either to one of us or another one of our team, who will be more than happy to point you in the right direction and get you on track to reach the top of that pyramid of retirement. So thank you for your time today, and we look forward to meeting with you individually soon.